Good morning, John. It's good to see you once again. We're recording this on Thursday morning, and big news overnight was that for the first time in 4 years, the United States Federal Reserve has cut interest rates. And not only did they cut rates from 5.5, but they cut rates by a big 50 basis point cut rather than the usual 25 basis point cut. John, this seems like a sea change for central banks. We had seen rates coming through, but the big dog among central banks is the Fed. And for them to cut rates, obviously, is a major signal. How did you interpret the overnight news?
Well, we can debate about whether it was expected 0.5% or quarter, but let's put it in context. If we were cutting 0.25% and the cash rate was 2.75, everyone would say, well, that's pretty normal. But we cut from 5.5 down to below 5. We think that's extraordinary, but it's the same ratio. So let's put it in context. When you have interest rates up so high, and we've been arguing for months, Paul, that interest rates in America are too high against inflation. We had real cash rates of about 2.5%. Nowhere else in the world do you have real cash rates that high when you take off inflation. They had to cut, and they had to cut and bring it back, to something which is more sustainable and sensible. So I'm not surprised. I think the market's not surprised. The market reaction, if you look at the equity market, the bond markets, there was a little bit of movement, I think, in 2- and 3-year bonds, but the rest of the market just said, oh, ho-hum, we expected that. And the futures market going into this, we're increasingly expecting 0.5%. Not totally convinced it was going to happen, but there was more bets on that than 0.25% coming through at the end. So it might have been a little leakage there of information, but who knows? So I'm not surprised. I'm not worried either.
And John, there's an old market saying, don't fight the Fed. And what that means is that when interest rates are going down, usually the share market is going up. Now, I've had a look at all the instances where the Fed has begun a rate cutting cycle. Since 1929, there have been 14 episodes. And if you look 12 months past the first cut, on average, the S&P 500 has risen by about 13%. So do you think that the next 12 months should be a good period for share markets if interest rates are coming down?
Well, this interest rate cut was so forecast and so delayed that there's a lot of expectation already in markets. And I think we said that as well. And that explains the initial reaction. Look, I think it's positive, steadily positive for markets, but not in an exciting way. The next question will be the movements of the currency, the American currency, and obviously it's going to be an issue for Australia. Theoretically, if we hold interest cash rates where we are and America cuts 2 or 3 times more, you'll see a re-rating in the Aussie dollar.
Yeah.
And that devaluation of the US dollar may help them on their trade account and may stimulate inflation again from imports. So that's just something to watch. And then we've got to look at the ongoing numbers coming out of the economy of America. There's clearly a slowdown in the labour market. And I think the Fed talked about that briefly last night. So we've got to watch that trend line. Is this enough to sort of stop that short-term trend of reduction in labour?
Yeah.
But, they needed to do it. They probably needed to do it 2 months ago. They probably needed to cut interest rates 0.25% 3 months ago and again last night. So they just put the double barrel there. So
yeah. So in the US, there are another 2 FOMC meetings before the end of the year, and I think the futures markets are expecting cuts at both those meetings. Whether the cuts are another go at 50 or 25 or a combination of the 2, who knows? But I'm just watching the Australian dollar live while we're talking, and it's up today, 67.6. And then the question, you referenced labour markets. We'll see labour numbers today at 11:30. Are you anticipating a weakness there, and then the RBA will come in with its own cuts, or do you think they'll wait till next year?
I think the big issue for Australia is that they had to wait till America cut it, because there's the benefit to the currency. We can't understate this, that the Australian dollar is undervalued, and we are creating inflation through imports, which we wouldn't do if we had a high currency. So waiting makes some sense. Absolutely makes no sense to put interest rates up at all. So I think that's off the table, and we should stop talking about it. It's only a question when we cut. Labour market issues are, what you're seeing is the number of people working is growing, but the unemployment rate is tracking up, and that's a result of immigration, where you increase supply. And as the economy grinds higher, we're not matching that supply with job openings. So that's what the unemployment rate will show. Slight increase, but nothing to worry about. The stimulation being created by the government is very much around social services. Nothing happening really in the broader economy outside construction, which we're way behind the curve there, and maybe engineering and infrastructure. That's probably where, but we don't have enough workers in those areas. It's been disclosed this morning. We actually can't meet the demand in terms of the employment. So Australia, its immigration program hasn't been thought through in terms of a long-term plan to immigrate people who can meet the demand for labour in areas of the economy but we've got people who aren't being demanded, so to speak, if you know what I mean. That's why the unemployment is going up. So just to answer it, I think we've got an interest rate cut coming in the new year. But what could surprise us, I think inflation will surprise, and in Australia, I think both the RBA and Treasury will be surprised. And I say that because I think, yes, the rise in the Aussie dollar will come through in the December quarter. I think Chinese deflation is coming through in imports. And then we've got the oil price move, which will be significant if that starts flowing through the economy.
Yeah. Just to remind people, the unemployment rate at the moment is 4.2%. So it'll same as it is in the United States. So it'll be interesting to see if there's a change today. John, with declining interest rates, obviously savers, retirees are going to find that the rates offered on term deposits decline. It's with the rise in the share market and the decline in the dividend yield of stocks, it's becoming a little bit more difficult to secure high income. We also said that there have been some changes with the rules relating to hybrid, which was traditionally one area where you could get a pretty secure, nice high yield. What did you make of APRA's new rules as far as hybrids are concerned?
Look, it's been flagged, but I think there is an undercurrent attack on superannuation funds, self-managed, self-funded retirees. They clearly, I think the numbers I saw, $40-odd billion market in hybrids in Australia, bank hybrids, and that's going to be wound up over the next 7 years. And any issues which happen in the next year or so will have to mature inside that 7 years. So the hybrid market's going to die, and I think that's a win for the view of the government, who wants to stamp out franking credits and the utilisation of franking credits in funding by banks. So I think that's an undercurrent which we should be concerned about. I thought the hybrid market was not, yes, you could say some of the hybrid issues need to be tightened up, but I think after decades of hybrids trading in Australia, I think the retail market was reasonably sophisticated. Now it dealt with that market. The wholesale market might complain about it, but that is really a retail market, and it's a way banks were funding their capital. Now we've changed that. We're going to bring in Tier 2 and debt securities and have more Tier 1, saying that's a better capital base for the banks. I would say that's arguable. I mean, banks, if you want the banks to be better capitalised, increase their capital ratios. Don't worry where they're capitalising it from or where they're raising it from. So I think there's a lot of nonsense being spoken about this, and it's disappointing. Australia has a massive superannuation market. We have a significant self-directed retirement market, and it's quite appropriate that, if possible and appropriate, that capital is diverted to supporting the banking system, which is vital to Australia. So I'm disappointed in that, but that led us to, and we were thinking about it, is pushing Climb Capital, our LIC, more into that income market and that pension market. And I think with these announcements by APRA, our share purchase plan sort of should be top of mind, particularly for those shareholders in camp to top up. We're showing a very nice yield. That yield is becoming more attractive as interest rates fall, as you say, Paul. We're sitting there at 1.35 cents per quarter, fully franked, so 5.4 cents on an 81-cent offer price. It's an attractive yield. So I just suggest shareholders that can, looking at this, they consider the share purchase plan, make their own inquiries, obviously, but that offer document should be with them now. And if there's any questions about it, please contact Climb and we'll be happy to talk to you. And we'll probably be making outbound calls in the next week as well to make sure people have their documents.
Okay, so this is Climb Capital, which is your listed investment company. The dividend equates to about 6.6%, if I'm not mistaken, fully franked.
Yeah, fully franked. So you're getting well above 9% of the current issue price, which, equity yield. We've really targeted that market. We've been trying to convey this for the last 3 years that, we want to stand out as a listed investment company which is focused on yield. Trying to grow capital, in difficult times, but maintaining and steadily growing yield. Not exceptionally, but when interest rates come down, then the yield becomes more attractive on those sustainable funds. So that's probably has happened in the last couple of weeks. The hybrid decision is going to take a lot of people by surprise, and they've got to find somewhere else to invest. TDs, as you said, Paul, yields are coming down there and probably going to come down again in the next 6 months. So that's going to fall away, and the closure of the hybrid market. Yeah.
John, I want to switch gear and talk about the energy situation in Australia, because there's quite a lot of ructions going on beneath the surface. First of all, Australia is a huge energy producer. We've got lots and lots of natural gas. We've got onshore oil. We've got offshore oil. We've got heaps of sun. We've got heaps of wind. The only things we haven't really got is we haven't got nuclear and we haven't got hydro. We're the dry continent after all. But I've noticed that there's always been a lack of a strategic vision for our energy sector. And at the moment, I'm reading, weird articles about oversupply of solar energy being switched off to support the national energy market. What's going on there? Do you understand it all?
I understand it. I mean, when you're dealing with a policy setting which is nonsensical, how can you understand it? I mean, there's two. I think we've dealt with aged care in the last week, so it shows what can be done if there's a focus on getting a result for the benefit of the community, and both sides of politics and the middle of politics, if we talk about the Greens, get together to formulate something. Now, housing is another aspect, and energy is a big aspect. Now, in the last week or 2 weeks, I've got 2 letters from my energy supplier. I won't say who they were. The first one was my bill. This is for my little property, rural property, and it's the same as last year. Well done, after the $75 rebate, but I've used 20% less energy. So effectively, I've paid 20% more for my energy after a rebate. Then I get a letter yesterday saying, oh, you know how we were buying back your solar back onto the grid? Because I don't have battery, I put it back on the grid, and I'm on the grid. Oh, we're not going to pay you any more for that. Then I read in the paper that the solar energy was not bought onto the wholesale market. It was turned off in South Australia because it was driving wholesale prices into the negative. And you just go, there's something seriously wrong in this country. Now, I don't have all the solutions, but I do see that it is so badly managed that something has to be done, and the politicians need to stop arguing and start coming up with solutions and start thinking about what's possible. Now, what is clearly possible, and I think about my own situation, so it's a bit micro, I would love to invest in batteries. Okay, I'd love to invest in batteries, but it's a big investment, okay, on my farm, and my biggest risk is, technology. So I buy a battery, I invest my 20 or 30 grand, whatever it is, then I find out in 2 or 3 years' time there's a better battery which has superseded what I've got. What nullifies my risk of that? Well, clearly I should be getting a tax deduction or a depreciation allowance. If I was a company and I invested in batteries, supplying my own energy, I would be getting depreciation on that capital investment. As a householder, I don't. And that has to be looked at. Further, surely to God in this country, we can start leasing batteries to households. So households don't take the technology risk, can offset the financial burden through a sensible policy with government support, using superannuation funds or the future fund, which seems to be doing nothing, to supply solar batteries across the market. Okay. Now, there's another big issue we know in terms of the distribution of solar back into the grid. Well, that's a government issue. The private owners of energy in this country, the 30-year journey that Australia has embarked upon to privatise energy has been an almighty disaster. I don't think there's any other answer for it. It should never have gone to private hands, but we're wearing it, and there needs to be some sort of partnership to get the solution we need. But you talk about abundance. We have abundance a couple of weeks ago of sun, abundance of wind. And now I think there's so many solutions which are sitting in front of our face for this energy crisis that it almost seems deliberate not to do it. It almost seems like there's an impediment, and I think it's coming from the private market, not what's in the best public interest. So that's my comment on that. And if we can deal with this, Paul, guess what happens to inflation? It comes down. Putting up the interest rates have no effect. I want to make another final comment because I don't want to bore everyone. Interest rates have no effect on the price of petrol. They have no effect on the price of electricity other than the marginal cost of capital, but that's another issue. But to make my point, and this is interesting, I read recently, what's the second-hand value of electrical vehicles? Now, all of a sudden, with technology growing at a great rate, we now realise that the second-hand value of used electric vehicles has plummeted. There is not a big market in second-hand EVs because technology is rapidly increasing battery power and the utility of these vehicles. And this is what we've got to understand as technology comes in, and particularly in the energy market, we've got to understand the repercussions for consumers, investors, and so forth. It needs to be thought through.
Well, thanks for that, John. Interesting as always. And until next week, have a good period on the market. All the best.
Yeah.